welcome to the World Battery Metals and Mining News for the 26th of August 2024. BHP warns China recovery uneven as profit creeps higher. BHP Group Limited, the titanic player in the mining game, rolled out a fairly predictable full-year profit, hitting $13.66 billion, slightly above market whispers. This was despite global commodity chaos and China's clunky economic recovery. The iron ore and copper segments bulked up BHP's revenue, but the flagging Chinese property market is throttling demand. CEO Mike Henry foresees iron ore oversupply into next year as surplus steel swamps the markets. Despite upping copper output by 9%, Henry's aspirations to pivot more towards energy transition materials took a hit with the botched Anglo-American PLC takeover bid. The company is contemplating a beefy expansion in Western Australia to hike iron ore output, but hold your breath. It's all riding on market whims. With iron and copper prices currently on a bumpy ride and a dividend drop to 74 cents a share, BHP is poised for a challenging terrain ahead. Amid all this drama, it's a marvel they managed a 3% revenue bump, though tanking coal and nickel prices did their best to spoil the party. Congo wants Trafigura partner Chemaf's deal with Norinco halted. In a revealing move, the Democratic Republic of Congo, DRC, has effectively opposed Chemaf SA's attempt to offload its copper and cobalt mines to China's Norinco Mining, a deal crucial for Chemaf due to their financial woes. The deal's opposition is rooted in DRC's mines minister, Kizito Pakabamba, citing violations of Chemaf's lease agreements with state miner Zijin. This spat underscores DRC's strategy to safeguard its mineral interests, especially against China's growing dominance. Chinese companies, driven by the burgeoning electric vehicle sector, have heavily invested in Congo, the top global supplier of cobalt. The plot thickens with Gécamines asserting its mineral rights over Chemaf's mines, further complicating the sale to Norinco, which already holds significant stakes in Congo's rich copper and cobalt resources. Canada to hit China with tariffs on electric vehicles. Steel Canada is gearing up to slap hefty tariffs on Chinese-made electric vehicles, aluminum, and steel, signaling a firm stance in line with its Western allies and a bid to shield domestic industries. Prime Minister Justin Trudeau is about to declare a 100% tariff on electric cars and 25% on steel and aluminum. This move mimics the protectionist measures by the U.S., with whom Canada's auto industry is deeply intertwined. Finance Minister Chrystia Freeland has been a vocal advocate for these tariffs, citing China's state-directed overcapacity as detrimental to Canada's EV sector. European Union has also joined the tariff tango, but with less stringent measures. As Canada's import of Chinese EVs skyrocketed, local automakers and metal producers clamored for more protective measures, decrying China's disregard for fair play. While the Trudeau administration has been generous with subsidies to North American and European automakers, it's now showing its iron fist to the east. China's potential retaliation and the geopolitical ripples, like their canola seed import ban over a Huawei executive's arrest, will be something to watch. But let's face it, this is as much about keeping jobs and votes as it is about standing up to China's economic maneuvers. Copper supply risks ease as Chile miners do deals. Chile's copper mining sector is navigating a transformative phase, successfully diffusing labor tensions that previously loomed large over the global copper supply chain. Recently, London Mining Corp saw about 300 striking employees return to work, while BHP Group's Escondida mine swiftly resolved a labor dispute following a brief 3-day strike. Antofagasta plc has also finalized an early wage agreement at its Centinela site, wrapping up its labor negotiations for the year. Although some contracts, amounting to 752,000 metric tons of supply, remain in the balance, this is a significant decline from the 3.35 million tons at risk earlier in the year. BTG Pactual's Cesar Perez Novoa notes that the fulfillment of most 36-month collective labor agreements has mitigated the threat of strikes. Notably, while companies are now spending more to finalize contracts, the falling copper prices since May have likely incentivized workers to secure deals. For the market, this decline in strike risk alleviates concerns about supply shortages, ensuring a more stable flow of the essential metal to smelters. Zijin Mining sees increasing threats to M&A ambitions. Zijin Mining Group Co., a major Chinese producer of copper and gold, is feeling the squeeze from a slowing global economy, geopolitical tensions, and the enthusiastic rise of resource nationalism. Despite a stellar performance with a 46% jump in net income to 15 billion yuan, $2.1 billion in the first half of the year, thanks to higher commodity prices and stringent cost controls, the company is cautious about the future. The US and EU's attempts to ramp up their own mineral production to cut reliance on Chinese supply chains are causing frowns at Zijin HQ. The company has already started to tap the brakes on acquisitions due to inflated project valuations and international friction. Amid these undertones, Zijin aims to extend its global influence while solidifying its presence in China and friendly neighboring nations. With the copper market facing a future deficit driven by green initiatives and AI, gold demand buoyed by geopolitical jitters, and lithium prices adjusting as supply meets demand, Zijin is navigating a labyrinth of opportunities and challenges. Nornickel examining impact of latest U.S. sanctions. Nornickel, Russia's mining heavyweight, is currently grappling with the fallout from new U.S. sanctions levied against its subsidiaries not tied to its core production and sales. The sanctions, part of a broader list targeting 400 entities and individuals aiding Russian military efforts, spared Nornickel's principal operations, but hit some of its service companies and the Bystrinsky copper-gold project, in which it holds an indirect majority stake. This project, rich in gold, copper, and iron ore and predominantly serving China, faces uncertainties as the company appraises the sanctions' impact. Pivoting to Asia has become Nornickel's strategy amidst Western buyers shunning Russian metals due to broader geopolitical tensions. Despite these maneuvers, the sanctions add another layer of complexity to Nornickel's logistical and financial operations. China's gold demand expected to rebound as economic jitters spur buying. Gold demand in China is expected to rebound as consumers acclimate to higher prices amidst economic instability and currency concerns, according to industry officials. This revival in the world's top gold market could bolster the ongoing rally in global prices, which have already surged 22% this year, hitting a record $2,531.60 per ounce. Despite the People's Bank of China pausing its gold purchases for 3 consecutive months, newly issued quotas for Chinese banks aim to regulate bullion flow. Seasonal demand and a strong investment interest will likely persist due to ongoing economic issues and the prolonged downturn in China's property sector. Although high prices might dampen jewelry demand, investment interest should counterbalance this effect. So while consumers' adaptability and China's economic performance remain to be seen, the outlook for the latter half of the year remains optimistic. It's almost heartwarming to see that economic uncertainty has one sure bet: gold. Iron ore price rebounds past $100 after Chinese stockpiles shrink. Iron ore prices have rebounded as China's massive inventory levels continue to decline, sparking hope among market bulls. Over the past 4 weeks, stocks at Chinese ports have decreased from a staggering 150 million tons in late July. Although iron ore is still nearly 30% down for the year, this drop in inventories suggests that the severe oversupply issue might be easing. However, the broader outlook for China's steel sector remains murky due to an embattled property market and a government push towards new growth sectors. In response, traders are keenly watching whether steel production will pick up after its recent dip, though July and August are traditionally weak months. Iron ore futures in Singapore rose 4.2% to 120 cents a ton, bolstered by a 5% increase the previous week. Meanwhile, base metals also saw gains on the Shanghai Futures Exchange, with aluminum prices hitting their highest since mid-July. Too bad the London Metal Exchange had to sit this one out, probably nursing a hangover from their public holiday. Volt Lithium starts field unit testing in Texas. Volt Lithium has initiated testing of its first field unit in the Permian Basin, Texas, aiming to double its previous oilfield brine processing capacity to over 200,000 liters per day. This marks a significant step towards becoming one of North America's pioneers in commercial lithium extraction from oilfield brine. The company's direct lithium extraction (DLE) method involves a two-stage process to purify the brine and utilizes innovative ion exchange beads that are a mere 5 microns in size, offering an impressive 800 times the surface area compared to standard beads, thereby boosting extraction efficiency. As a result, Volt plans to start field operations by Q3 2024, which coincides with their previously set timeline, adding another notch to their belt in battery-grade lithium production. Interestingly, this major technological leap underscores the role of advanced engineering in enhancing project efficiency, all while Volt's shares saw a healthy rise of 5.7% in Toronto, bringing its market value to $63.1 million. Harmony Gold sees profit surge as prices rally. Harmony Gold, South Africa's premier gold producer, has announced a doubling of profits for the fiscal year ending June 30th, thanks to increased output, improved grades, and a buoyant gold price. Preliminary data shows headline earnings per share at 98 cents, a significant leap from last year's 45 cents. They achieved a 6% rise in gold production, hitting 1.56 million ounces, slightly exceeding their target. However, all that glitters isn't gold. Harmony took a hefty $157.51 million write-off on its Target North project due to disappointing mineral reserve estimates. CEO Peter Steenkamp hinted the project's future is uncertain, with further studies pending. Harmony is wisely hedging its bets, considering the more promising Eva mine in Australia and the Wafi-Golpu gold-copper venture in Papua New Guinea with Newmont. As South Africa's aging and dangerous gold mines become less viable, Harmony, like many of its peers, is shifting its focus to other minerals and regions, particularly copper. This pivot is strategically sound, given the surging demand for copper in electric vehicles and renewable energy, a market that has seen copper prices soar to new heights this year.